Hello and welcome. You're joining us live at the Investor Lab, the epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Goose.
My name is Gabby.
Gabby, how are you today?
Fabulous. How are you?
I'm pretty good.
Pretty good?
Yeah, pretty good.
Yeah, pretty good.
Yeah, pretty good.
That's pretty good.
Yep, pretty good.
Good.
So I'm excited for our second week of doing this live. I really loved it last week. We've got a couple of people. If you are here joining us live, let us know in the chat. We'd love to see you. We'd love to hear from you. The more you interact, the better it is for us. That's why we're doing it live, so we get to interact with you guys. So if you're here, give us a quick hello. Let us know that you are here and with us. Hey, Bronwyn. Nice to see you.
Hello.
So super excited for this. Of course, if you are joining us live or if you are watching this later and recorded, make sure you hit the like and subscribe button. That's obviously going to help us grow what we're doing here and build a bigger community, but also actually it's going to help you make sure you get the notifications for when we're going live and all that kind of stuff. Hey, Mina, nice to see you. Nice to see you taking some time out of your lunch break, Mina.
Hey.
Matthew, JCP81, nice to see you too. So exciting to have a few people here.
Awesome.
So what are we going to be talking about today?
So we are going to cover a topic called liquidity. And so if you're in the kind of money economics world, you are familiar with that term. But I think a lot of people hear that word and they're like, I don't even know what that means. You obviously believe it's super important to understand.
Yeah.
Particularly, following on what we were talking about last week. If you didn't see last week's episode, go back and check that one out. Hopefully you have already, but we really did a high level, the fundamentals of what is money and how money works and how it's kind of factoring into the current economic situation. And part of that, kind of the part two, is understanding liquidity, which is really like the supply of money and how it all moves around, right?
Yeah, I would probably say it's more like the movement of money, if that kind of probably frames it up sort of slightly differently. So last week we talked about money and monetary creation, M3, monetary inflation, all of that kind of stuff, how that translates to monetary debasement, and how the debasement of currency and nominally increases optical asset values.
Yep.
Liquidity is related to that, but it is also slightly different. So the easiest way to think about liquidity is it is the movement of money around the economy. So liquidity, I think, is the greatest driver of asset prices. And I'm going to come back to that statement in a minute. But there's a really interesting story that I really think kind of frames this up really well. So there's a really great investor called Stanley Druckenmiller, and he's often seen as the best investor of all time, better than Warren Buffett and all that kind of stuff, because he got he's a money manager and he ran a hedge fund or some kind of money management fund, and he got over 40% returns every year for like 40 years, right? Which is, but it's just an
That's not bad.
It's an insane, absolutely insane record.
Yeah.
Now, when he was just sort of a young analyst and just sort of cutting his teeth, he was working for George Soros' firm. Now, George Soros, a lot of people think he's some super evil dude. I don't have an opinion. Oh, I think we might have just lost.
Good. We just lost the screen.
We've just lost the screen. Okay, cool, fine. So I don't have an opinion on George Soros, but the point is Stanley Druckenmiller was working for George Soros, and he was this, really excited analyst, and he thought he'd found this great new thing to invest in, and he went to present. He got his opportunity to present his case to George Soros. He was like, I think we should invest in this, and here's all my analysis and all of this kind of stuff. And George Soros turned around to him and said, "What makes the stock price move?" And Stanley Druckenmiller didn't really have a good answer. And so he went, that's really interesting. What makes the stock price move? He had all these reasons why he thought it was a good thing to invest in, but he couldn't actually answer this fundamental idea of like what actually makes the stock price move. So he went away and he did all this stuff. And he went on this whole journey, and he finally came back and he said, I know what makes the stock price move. It's liquidity. Now, the interesting thing about liquidity is effectively the flow of money within an economy or through into other economies. That's called cross-border capital flows. And if you can understand that, the first thing you would want to understand is where is the liquidity going to flow and why. So where is the money going to flow to? So think about money in the world as being this kind of whole liquid form, and it can flow to different parts of the world. So it can flow to different countries. And it can flow into different pockets. It can expand and contract like a tide, and also it can find its way into specific assets. So if you can understand that liquidity is the driver of asset prices, then you would want to understand where is liquidity going to flow and why. And then you would also then want to understand into what assets would liquidity flow and when. Now, liquidity expands and contracts over time. So it goes through these cycles. Now, as it expands, so when liquidity expands, the easiest way to think about that is that money flows into heaps of stuff, right? So if you think about money as this kind of easiest kind of way to think about it is almost like an ocean, right? So the tide comes in and everything, there's more water all over the beach and it fills up all the rock pools and you can't see the rock pools anymore and everything's full, right? So that's when you kind of see like stock prices going up and house prices everything's going up because there's more liquidity. But then as liquidity contracts, then the question is what assets or what types of assets would retain that liquidity, because it doesn't necessarily contract equally. And so this is where you've got to think about asset allocation and how you might find where it might stick into different assets, because money at the end of the day, money is a coward. Money always goes to the safest place. Where is it going to be the most likely place for it to be? And so as liquidity expands, you can see asset prices go up. So knowing and understanding how liquidity expands and also where it expands to, because it doesn't expand equally, right? So global liquidity might expand, but it might expand more into the US than Australia, for example, right? So it might flow more over there, but in aggregate, global liquidity might increase, but it might flow more into one country than another country. So understanding why that might happen is really, really important. But then also, if it contracts, or even as it expands, what assets are going to benefit most from liquidity? Or what I actually find most interesting is as it contracts, where is liquidity going to stay? Because what that actually points to is what actually gets demonetized. So for a really good example of that is, if you imagine that liquidity and like money supply and there's money flying around everywhere, gold prices go up and Bitcoin prices go up, let's just use those two as an example. But then if liquidity contracts, well, and this is just a hypothetical scenario, if Bitcoin held its value and gold values went down, then you could infer that gold had been demonetized in favor of Bitcoin because the liquidity had flowed out of gold and into Bitcoin, right? So if you think about it as this kind of like expanding and contracting pool of money that has reasons that it flows into different parts of the world, and different countries are disproportionately affected by liquidity in different ways.
So that was a lot.
Yeah, sorry, yeah.
It was great. I want to get to the crux of why does liquidity impact asset prices specifically?
So last week we talked about the quantity theory of money, right? So we used this idea that if you just take Australia, and if you say Australia at any given point in time has a certain amount of goods, services, and assets, right? Good services and assets that you can buy, and there's a certain amount of money in Australia, and that total amount of money in Australia divided by the total amount of goods, services, and assets creates the dollar value for those goods, services, and assets, right? Now, there might be more demand for Vegemite than there is going to be for Marmite, and so Vegemite might carry a premium because more people want to buy it, so on and so forth.
Yep.
Or more people might be interested in a certain type of service than another type of service, or people might be more interested in spending money on recreation than other. So money flows disproportionately into different parts of the economy. But if you just think about Australia as being a bucket of goods, services, and assets, and there's a certain amount of money and it gets divided by the goods, services, and assets, that gives you a general understanding of how that works. Now, just imagine for a moment that that we have a certain amount of money in Australia, and let's just say a whole bunch of money came from overseas into Australia and increased the amount of money in Australia by 30%. What would that do? Well, that would, in aggregate, drive up the total value, or the nominal value, more specifically, of all of the goods, services, and assets in Australia by 30%. Now, that wouldn't be evenly distributed, right? Because money is not going to flow equally into everything. It'll flow into some things more than others. So most likely what it's going to flow into is things like assets, because that's where money can stay safe. Because what happens when liquidity expands is, yes, people will spend it on consumables. You broadly have two baskets. You have consumables and assets. So money will flow into both, i.e. so if you have a high liquidity environment, so if we go back to when interest rates were like 0.1% or 1%, there was quantitative easing, the government was printing money, there was money flying around everywhere. So what were people doing? People were buying new TVs, they were buying new cars, they were going out for dinners, they were spending money, right? Some of those things retained that economic premium, i.e. the houses and the other assets, and some of those things did not, i.e. the cars and the things depreciate, the things that are not good investments. So money disproportionately flows into these kind of the assets that retain value. So just to go back to it, so if Australia suddenly had twice as much money, had the same, like, let's say it's got 100 units of money and then another 100 units of money came in from overseas into the Australian economy, what that would do would be to optically drive up the nominal dollar value of everything across Australia, because you're effectively dividing the total money available by the total amount of goods, services and assets in the country. Does that kind of make sense?
It does.
So when you think about that, now the reason that's important is because really we're just playing a game of optical price variation. We're not actually talking about like real value is not changing in a lot of things. In fact, real value should actually drive prices down. We talked about this last time. We talked about the idea that in a free market, all prices fall to the marginal cost of production because value is created by providing more for less over time. So theoretically, the more value you create, the more prices should go down, which is a very kind of like interesting idea. But what actually happens is as monetary supply increases, but then also as that money moves around through the economy, optically prices change. Now, a different way to think about this is the Australian dollar versus the US dollar. Okay, so everyone knows that there's a difference in price between the Australian dollar and the US dollar. Now, if an Australian, I don't know what the price is for a kilo of beef, but let's just say it's $10, right? Right? I don't know what the price of a kilo of beef in Australia is. Let's just say it's $10, right? If an American wants to buy, if the Australian dollar and the US dollar were on parity, right? So one Australian dollar equaled one US dollar. Then the price for an American to buy a kilo of Australian steak at $10 a kilo would cost $10 US. If they're not at parity, so if the Australian dollar is worth one Australian dollar and the US dollar is worth $1.60 US, then it's going to cost the American less to buy that Australian steak, right? So then we start to get cross-border capital flows. But nothing's changed about the steak. For an Australian perspective, it's still $10, but for somebody else's perspective, it's actually gone cheaper. The inverse is also true. So if you think about what drives asset prices, it's liquidity. Now, let me just riff on that for a second, because most people listening to this are going to be really into houses and house prices. And so we think about, people may sort of intrinsically sort of understand liquidity and think, okay, yeah, cool, it's like interest rates and stuff like that, but that's not actually the full picture. Because if we look at interest rates since they started going up on the 5th of April 2022, Tuesday, 5th of April 2022, interest rates went up by 4,250%, so something like that. They went from 0.1 to 4.35%. That's the Fed funds rate. So that's obviously gone up significantly. Now, you would imagine that if interest rates had gone up that fast over a fairly short period of time, that would cause a slowdown in property prices. However, over the same period of time, property prices across the country in aggregate, on average, have gone up by 11.08%. Now, the question would be why? Okay, so if your interest rates have gone up, and it's harder to get debt because the debt service ratios are harder, so it's actually harder to get a loan, access to credit has gone down, why have house prices gone up? Now, we can say immigration, we could say all of this kind of stuff, but actually fundamentally it's driven by liquidity. Fundamentally it's driven by the fact that governments have been running at deficits. So in fact, Michelle Bullock in one of the recent RBA meetings said, you know what, we would love to lower interest rates, but we can't because inflation is still really high because the state governments keep spending too much goddamn money. Right now, she obviously didn't say it in those words, but that's basically what she said.
Governments.
Yeah, so what's happening is they're still pumping liquidity into the economy. So interest rates and liquidity can operate separately and differently, right? And so that pumped liquidity into the economy, and that liquidity finds its way into typically goes into store of value assets in a primary kind of fashion. Now, another factor that has impacted liquidity in Australia, which is really, really interesting, and this is separate to money supply. So we talk about money supply and we talk about the creation of money. But one of the other things about the Australian economy is it's a net importer of capital, which means that more money comes into Australia from overseas than goes out of from Australia to overseas. And so we actually have more money coming in, and also because Australia has kept its interest rates higher than other countries, for longer. So the ECB has been lowering interest rates, the US has been lowering interest rates, Australia hasn't. What that has created is an opportunity for people who are seeking better, high yielding treasury assets to buy Australian bonds and therefore get a higher premium. So that actually attracts international capital into the Australian market as well, which supports more capital flows in Australia. Now, just quickly, I know I'm dumping a lot of stuff here, but the whole topic is really, really fascinating because there's a lot to it and there's a lot to unpack. And by the way, hey Bella, hey Nicole, by the way, nice to see you guys here. If you guys have any questions as I'm going, if I'm saying stuff that you're not understanding, just let us know in the chat because I can move pretty quickly sometimes and it's hard for me to make sure that I'm breaking it down to the right level for everyone to understand.
I feel like everyone's sitting there just like me, like, okay, taking it in.
So there's effectively three sources of liquidity. So there's central bank liquidity. So central bank liquidity, which is created through interest rate policies, quantitative easing, stuff like that. It's also by running budget deficits and increasing sovereign debt levels. So quantitative easing is the production of new money into the economy. Interest rates is the expansion and contraction of credit availability, effectively, or the price of money, effectively, is interest rates. So there's two different functions: the creation of money and the price of money. But then also, what happens when governments run at a deficit? That money effectively gets created into thin air through the creation of credit, right? Because you can't spend money that you don't have. So you hear about a government and they're in a deficit. It's like, okay, what do you mean? Because like, where did you get the money from? Because if I run at a deficit, I have to borrow the money from somewhere. Yeah. So if I like don't have enough money to, I don't know, and people do this all the time. I don't do this, but just to use this as an example, there's plenty of examples of people like, oh, I'm really short. I don't have enough money this week. You know what I'll do? I'll go get a payday loan or I'll go and put money on a credit card because I'm going to spend money I don't have. That money is credit. So when governments run at a deficit, where's the credit card? They don't have ones, right? So that actually accrues on the balance sheet as a debt, right? But that is in effect liquidity pumping into the system, and that's what's been happening. And in fact, if you look at the US, that's a really big issue in the US because the US is running at about 127% debt to GDP, government debt to GDP, by the way. Australia has much higher private sector debt, which is where the second cohort of liquidity comes from. So the first cohort is central bank liquidity. So that's through interest rate policies and monetary policies, quantitative easing, all of this kind of stuff, monetary and fiscal policies. Then you've got private sector liquidity, which is banks and financial institutions, lending, loans, all of that kind of stuff, credit creation. And then you've got cross-border liquidity, which is the movement of money from one country to another. So for example, the PCB, the People's Central Bank of China, so they might go on a big money printing spree and they might create a bunch of liquidity in China. We might think in Australia, well, why would we care if China increases its liquidity? Well, what's going to happen there is probably they're going to weaken their currency, which is then going to make, which will turn them into a net exporter or increase the ability for other people to buy their goods and services, which means that more money will flow out of Australia into their economy. But also, inversely, they would have more money that could flow out of their economy into the Australian economy. So the movement and the cross-border capital flows is a really, really, really key thing to understand as well. I'm going to keep going because there's really interesting really interesting secondary point on this. So we have been in a cyclical uptrend of global liquidity for the last 4 years, roughly, where global liquidity in aggregate has been expanding. Now, global liquidity tends to increase in going sort of like 5 to 6 year cycles, go 5 to 6 years of expansion, then a small amount of contraction, then some expansion. Now, typically, liquidity contraction means that asset prices go down for the same reason that an increase in liquidity makes asset prices go up, because you're removing money from the pool, right? So you're taking money away. Mm-hmm. So things get sold, things get liquidated, people try and, there's less money in the system. Now, some assets are going to disproportionately hold that capital, and that's the monetary premium or the demonetization of some other assets in favor of those. Now, what's interesting about this is the US dollar, so you'll hear me talk a lot about the US dollar. The US dollar as the global reserve currency is a very important thing to understand. 60% of all global debt is US dollar denominated debt. Now, the thing about that is if you're the Turkish government and you have $100 billion of US dollar denominated debt and the US dollar becomes stronger and the Turkish lira becomes weaker, then it is going to suck more liquidity out of Turkey. Because in real terms, if Turkey's devalued its currency, which is it's been crazily doing that over the last couple of years, so the Turkish lira has been going down in value, and the US dollar has been going up in value, the amount of Turkish lira required to make the debt repayments in US dollar denominated terms is higher, so it sucks more of the money out of emerging countries into places like the World Bank and all of this kind of stuff. Mm-hmm. So what you look at in aggregate is global liquidity, but it's in dollar denominated terms. And so it's kind of an imperfect metric because you can kind of see, okay, in aggregate, global liquidity seems to be increasing, but if the US dollar gets stronger, then versus the rest of the world, then you might see an optical reduction in liquidity as money is both sucked out of economies and is priced in US dollars, which there's a disparity between those two. Because even if you look at the Australian dollar versus the US dollar, the Australian dollar is down 11% versus the US dollar, but the US dollar versus the rest of the world is up by 10%, right? So the US dollar has actually gotten stronger since October. So what that can do is that can create a liquidity suck, which pulls money out of some economies and pushes money in to other economies. And this is the kind of the cross-border capital flows and how to think about that.
Okay.
So where do you want to go? So where do you want to go with that?
Where do I want to go with that? Let me just process all the questions that came up. I wanted to let you go. I think maybe looking into why certain things. So let's say interest rates in the US.
Yeah.
That has a direct impact on things like affordability in Australia.
Yeah.
Why is that the case? Because I feel like that's something that people can connect to. As Australians, you hear people commenting on things like US interest rate calls.
Yeah.
Trying to understand why that economy and the change in interest rates over there actually impacts asset prices in Australia.
So it's a really good question. So interest rates are one of the mechanisms by which liquidity is influenced, right? So lower interest rates means cheaper cost of capital, which means effectively it's more money flying around in the economy, right? Because the cost of capital is cheaper, like the price of money. Think about interest rates being as the price of money, right? Yep. Now, if you also then see that the US dollar is the global reserve currency, so it kind of is the temp check for everything. It's the main currency of the whole world. So if the price of US dollars gets cheaper, and not only does that, so if you go back to the debt burdens on all of the rest of the world, right? Their cost of capital to repay those debts gets less, which means they have more money to spend, right? So it, in effect, creates more global liquidity. So lower US interest rates creates more global liquidity because debt service repayments for most of the world go down. They've got more money to spend. Cost of capital in the primary currency of the world is cheaper, which means that more people are lending. Access to credit improves. Credit creation expands. That creates more money. So in effect, lower interest rates in the US creates more liquidity in the system. Okay. Now, Australia is disproportionately affected by global liquidity because it is a net importer of capital, right? Which means that we have more money that flows into Australia than we have the money that flows out of Australia. And so if we think about that, if there's a global liquidity tightening, that means less money is going to flow into Australia, which means the Australian economy can struggle a little bit more because we have less money coming in. Now, the other way to think about that as well is US dollar strength and US dollar weakness. So if the US dollar is strong, then that is actually good for Australian exporters that are selling goods to the US because it'll appear to the people in the US that it's going to be cheaper to buy Australian goods and services. Even though the Australians, the price won't be any different. It's still going to be a $10 for a kilo of steak or whatever it is, right? So that can actually increase exports, but in aggregate, it decreases liquidity and decreases money flows into the country, right? So the easiest way to think about this is, in aggregate, if there is more liquidity, then we see more growth. And if you have too much liquidity, then there's too much growth, and the economies can move too quickly, and you get lots of inflation. because the economy starts to get out of control. And if you have liquidity contraction, then you have less spending, and that can lead towards recessions. So this is the sort of expansion on that. Australia is a very unique country, the fourth least densely populated country in the world, and also, I think in the top 20 economies in the world, right? So we punch way above our weight in Australia, but because of that, we're disproportionately affected by the international liquidity scenario. Okay, so as global liquidity expands and contracts, Australia is just disproportionately affected by it, way more than the US, because the US is effectively at the central node of which, so everyone else gets disproportionately affected versus the US, but then Australia gets disproportionately affected because, for example, we have a strong reliance on China. If China versus the US has some kind of is struggling there, so like the tariffs that Donald Trump is talking about for the US, that could affect the Chinese economy. We have a high reliance on the Chinese economy, so there's all these kind of factors there. Does that kind of make sense?
It does. I think like when I started learning about this a couple of months ago,
yeah,
a big kind of mental shift and understanding for me was just the concept of, it sounds so basic, but the global economy.
Yeah.
And how money is a thing that just moves around cyclically in different paths, but it's all kind of interconnected. And I think as we earlier in life, you're much more insular and you just think about kind of where you grew up in your country and you learn more about the history, and that's debatable, but of your country, you learn about that and it's very insular, and you're not thinking too much about how your country being a player in the global world, the global economy, how they interact with each other, and how in this sense, money moves and flows between everything. And I think that was a big kind of realization that we are just a player in the game, which is the global economy.
Yeah.
Yeah.
Yeah, and I think that's a really important thing to understand. So, like, the US economy is very strong. It's been very, very strong for the last, since like basically 2008. So the US dollar, or the index to look for is an index called the DXY, the DXY. So the DXY is an index of US dollar strength versus a basket of international currencies, including the Japanese yen, the yuan, the euro, the pound, all of this kind of stuff, right? And so it kind of gives us a sense of US dollar strength. Now, because the US dollar is strong, what tends to happen is a lot more capital flows into the US, because if you think about it from the perspective of like what we were talking about last week, the debasement of currency, if you're in Turkey, do you want to hold Turkish lira or do you want to hold US dollars? Now, US dollars might be getting debased at 10% a year, but Turkish lira might be getting debased at 100% a year. So compared to the lira, the US dollar is as good as gold, right? Even though it's not, even though it's debasing, right? It's standing still versus something that's falling away at a much faster rate.
Yeah, I just want to double click on the debasing thing. I know we touched on it last week. What do you mean when you say debasing?
So debasement of currency is the systematic devaluation of currencies through the increase of supply of that currency, right? So the increasing of the amount of any currency in any economy is going to, based on the quantity theory of money, is going to lower the nominal purchasing power of that currency relative to other things, right? So if something holds value, so if the average Australian house price is $1 million, and then instantly we just click our fingers and then create twice as many Australian dollars, the $1 million house wouldn't change in value. It would have the same utility value, it would have the same demand metrics, all of that kind of stuff. What would happen is it would cost twice as many dollars to buy the same house that it cost $2 million to buy the $1 million house, right? So that is in effect debasement, and that happens in aggregate in Australia. The Australian currency is being debased by about 10% a year. It's about the same in the US, all that kind of stuff. Now, so thinking about the global economy and why this actually matters, right, is understanding how and when and why capital moves around these different markets. So a lot of capital flows into the US, particularly US equities, right? And so that's where a lot of money goes from the international, from the global market, from the global economy, flows into the US in search of equities, because US equities tend to perform a lot better than other equities. Now, the Australian equity market is not as good as the US equity market. The Thai equity market is not as good as the Australian equity market. Now, different types of assets, though, perform differently in different ways. So the Australian real estate market globally is the best real estate market in the world, right? So there was a question last week in the chat about emerging emerging real estate markets. There are no real estate markets that I can see in the world that even hold a candle to the Australian real estate market.
I was just going to ask, is that a literal definition? It is the best in the world, or is that an opinion?
Well, I mean, we'd have to get some data.
I'm sure it's all opinions, but
yeah, I mean, look, there's everything is opinion to some degree.
Sure.
I think you would have to define good, but in terms of stability, growth, demand, return on invested capital, any of these kind of metrics, it is certainly the best that I've seen. Can you get higher yields in other places? Yes, you can. Are the markets as stable? No. Like the US real estate market is nowhere near as stable as the Australian real estate market because they have non-recourse lending. So if you don't want to pay the loan, you just leave the keys in the house and leave. Just walk away. You walk away and you don't ever have to pay back the loan. And so there's different policies in different countries which create more instability in the real estate sector. The Australian real estate market is very unique because policy decisions have been made to create a very structurally sound real estate market, plus coupled with the fact that we have an excess demand versus supply. There is way more demand than there is supply in Australia. There is no current plan or strategy to increase the supply of real estate in Australia to meet the level of demand in Australia. Therefore, you have a massive supply and demand imbalance. On top of that, you have a currency that's debasing at an average of 10% a year, which is pushing up asset prices. On top of that, you have increases in liquidity that are pumping into Australia because the Australian economy has, for example, had higher interest rates, so that attracts cross-border capital flows. The Australian state governments have been running at deficits, which has been increasing liquidity into the economies. Like all of these things, we have all these structural things that are driving up the Australian housing price. So Australian real estate is from an investment perspective, I can't think of a single better place. Now, you're not going to get the yields, but also guess what? You don't get yields on Tesla either, but you can get a 20,000% return if you just held Tesla for the last 6 years or whatever it is, right? So thinking about returns differently, and by the way, we should do a podcast on yields versus growth because I have some interesting controversial opinions about that too. But so Australian real estate attracts a lot of international capital, right? And it attracts a lot of international capital. US equities attract a lot of international capital.
Yep.
A lot of money's flowing out of Europe at the moment. Why? Because their economies are not strong. They're not producing anything of a significant amount of value. Their real estate market isn't great. Their equities are not great. If you're a company and you want to go public and you want to get access to the best capital market, you go to the US, which means that there's a self-reinforcing loop that all the best companies go to the US, and so all of the capital that's chasing equities goes to the US. So the companies go to the US, they leave Europe, they leave Australia, they leave Africa, they leave all these places, they go to the US, they domicile there, they list on the US stock market, capital flows to the US stock market, that reinforces that. Australian real estate, again, attracts a certain pool of capital. European real estate, no good. Like, yeah, you may be able to get high yields, but what are the vacancy rates like? Can you get access to good data? All of that kind of stuff. Yeah, you can buy a villa in Bali and get an 11% yield, but is that, how stable is that going to be? What's the supply mechanics like? You don't have access to good data. So a lot of capital flows into the Australian real estate market, which creates a perpetual bid for the Australian real estate market too. So understanding that we are part of one larger economic system is really, really, really important. And also understanding how the differentials between interest rates and policy decisions in different countries affect capital movements, particularly cross-border capital flows. Now, the way to think about that is governments have to buy and sell bonds, right? And the price of a bond is going to indicate, or the interest rate on a bond is going to indicate both the strength and the risk in the economy that people perceive when they're buying those bonds, right? So if I wanted to lend you money, right, and you had a terrible credit score, you defaulted on all of your credit cards, all that kind of stuff. You're like, hey, can you lend me $1,000? I'd be like, well, that's pretty risky. Like you've got a track record of being very bad with money. That's really risky for me. In order for me to want to lend you money, I would want to charge a significant premium on that. So if you're a country like Nigeria, which has nothing against Nigerians or Nigeria the country, but massive debasement of their currency, poor fiscal management, all that kind of stuff. If they wanted to issue a bond, right, and they wanted to get people to want to buy that, they would need to offer a really significantly high interest rate because there's a significant risk premium. Okay, so thinking about that as well, it's not just about what the policy rate is, but it's also what is the risk, the perceived risk. Yep. So Australia has a really stable economy. It's very economically one of the best countries in the world economically. We've had the most stable, fewest recessions, all of this kind of stuff, and so. From a capital movement perspective, there's a lot of demand for Australia for capital to move into Australia, particularly as well because the interest rates are a little bit higher than US. Now, what's interesting about that? Let me just go a little bit further. So, since 2008, there's been a phenomenon where all of the government debt refinancing cycles have synced up. So, the average, the way that governments raise debt for themselves is they issue bonds. Right? And so what happened in 2008 is basically the whole world reduced their interest rates to zero because we had the global financial crisis. And in effect, at the same time, they refinanced all of their debt, and that basically synced up all of the debt cycles. Right? So now the average maturity on the bonds that they're issuing is 3 to 5 years. So we'll call that 4 years. So we get this kind of like 4-year cycle of debt maturity as well. And so one of the things you can start to look at is you can start to read the liquidity cycle and how that's moving. Now, globally, it's been following this amazing kind of sine wave pattern or this amazing trend. And we're sort of getting into the point now, the 2025 to 2027 debt refinancing, they call it like the debt maturity wall. And the problem that a lot of governments have at the moment is that their interest rates are too high. So if they have to effectively refinance the debt on a higher interest rate, that means their debt repayments are going to be really high. And that's going to be bad. I mean, they've got all this debt that they effectively are carrying at like almost 0% interest rate, probably, right? Now they're going to need to refinance it at, I don't know, 4%, 5%. That's significant when you're talking about huge amounts of debt. Now, what's interesting about that is Australia has broken from the rest of the world in terms of its monetary policy trends. So the rest of the world all started lowering their interest rates at the same time. And it seemed obvious to me that the reason they're all doing that is because they're all looking at the debt maturity wall going, we're going to have to refinance all this debt in the next few years. So we're going to get the interest rates down so they can refinance it and not bankrupt the economy. Now, Australia's government debt to GDP is actually pretty low. I don't have the numbers on me right now, but it's like 40, 50%, right? It's actually not that bad. Australia's total debt to GDP is like 250%, right? So public and private debt in Australia, private debt, so company and household debt, is way higher than many other countries. So our total debt to GDP is like 250%. It's very high. But our government debt to GDP is a lot lower. Okay, so the risk with the government of carrying the interest rates higher for longer is lower than other countries, because other countries have got a significantly higher government debt to GDP ratio. Like the US is 127%, which means that as a proportion, if the interest rate they refinance on is higher, their interest expense is going to be a lot higher, and that puts a significant higher capital burden on the government, which means that they're going to run at deeper deficits, which means they need to borrow more money, which they go into a sort of a debt spiral. That's not the case in Australia. Now, the reason that's interesting, the reason I bring that up, is because it feels like what Australia is doing is shifting slightly out of this kind of like synchronized wave of debt refinancing. And I think that's a good thing. I actually think that that's good because I think that that'll create a kind of counter-cyclical capital movement into Australia. So as other parts of the global economy tighten or weaken, capital will flow into Australia in a disproportionate way.
It's interesting that it's like slightly shifting a little.
Yeah.
Yeah. We're talking obviously at the global level in terms of, mentioning Australian real estate attracts international capital in.
Yep.
I kind of want to point out the elephant in the room that I think people might be thinking about. Bringing in more capital into the country, meaning asset prices go up, right? If you are an asset holder, that's a good thing in terms of your wealth, but obviously it is a negative thing in terms of improving housing affordability for people.
Yeah.
So I just wanted to kind of raise, I think a lot of people have this understanding that if you buy an investment property in Australia, then that's what makes affordability worse, because you as an individual are basically taking an asset out of the supply and thus pushing up prices.
No.
But it seems like liquidity is much bigger.
No. Buying houses actually isn't the issue, right? So the easiest way to think about this is, and I'm not sure if we mentioned this last week, but real estate investors make up about 30% of or 1/3, so 33% or whatever, but we'll call it 30% for the point of the discussion. Yep. Roughly 30% of the total property owners in a property ownership in Australia. So roughly 30% of all properties in Australia are owned by property investors. Yep. Now, this is not exact numbers, but let's say the Australian median house price, average house price is $1 million. Okay, if we clicked our fingers and overnight said every property investor has to sell all of their properties, property investment in Australia is illegal, they all have to go to market tomorrow, like bang, what would likely happen? Okay, we'd have 30% supply come onto the market. Reasonably, you would think, okay, well, property prices might go down by, let's say, 30%, right? So that would bring them, just simplicity, we'll call that $300,000. We'll go from $1 million down to $700,000 average house price across Australia. Okay, does that suddenly make it more affordable? No, because most people can't afford to buy a $700,000 house. Mm-hmm. So the issue is actually not that, right? The issue the issue is actually fundamentally that we have a supply and demand imbalance, and we have a debasing currency, right? Mm-hmm. So the currency is debasing at 10% a year. Wages are going up by 1 to 3% a year.
Yeah.
Right. And so that is actually the thing that is causing the lack of affordability in Australia. Yeah. Now, the thing about this and the thing to understand is if global liquidity, or if liquidity, so there's global and local liquidity, okay, right? And they're related, but they are different, right? So you can have the Australian government increase liquidity in Australia. So you could have, just let's say, imagine a scenario where the rest of the world was, I don't know, doing QT, quantitative tightening, and shrinking the money supply and all of that kind of stuff. But then Australia said, money print to go, brr, we're just going to print the money, right? Now, a whole bunch of reasons that would be a terrible idea, but let's just say that happened, right? You could have local liquidity increase. Yep. And that would do all kinds of things. That would massively stimulate the local economy. It would debase the Australian dollar. That would create a heap of net exports, because every other country in the world would be like, well, Australian stuff's cheap as chips now because it's not worth anything, right? So it would change the dynamic significantly. But you could have a massively increase in local liquidity, but not an increase in global liquidity. Vice versa, you could have an increase in global liquidity, but then you could have a whole bunch of quantitative tightening policies happening in Australia, which could decrease local liquidity. So they are different, right? And they are meaningfully different. Now, one of the things that's really important to understand, though, is that if you're in a period of liquidity expansion, asset prices are going to go up. If you are not participating, you are going to get left behind, because in aggregate, you're getting left behind anyway. You're going to get left behind faster in a cycle where liquidity is increasing, right? If liquidity contracts and you don't own assets or you're not invested, you're going to get further behind. So it's this kind of like a ratchet, okay? And so you're either going to ratchet up or you're going to ratchet down based on how you participate in these cycles. And that's actually the thing that people need to understand. This is actually why it's so important. So when we very first started Dashdot, it was like, okay, we want to help people not make investing mistakes. Great. So we were like, all right, we're going to find where the latest hotspot is, right? So we're going to find how to get into the markets at the right time, to find the best investment locations, all of this kind of stuff. So we can, they're awesome, great. And we took a bottoms up approach, right? So we were like, what's going to drive the local markets? Now, we cooked that effectively over years. We cooked that down to 3 things: jobs, lifestyle, and affordability, right? And affordability is relative local affordability. Now, that's great, but actually, if you zoom out a little bit further, that's the bottoms up model. That's like, what's going to drive this suburb? Why would one house in one street go up more than one house in the next street in the same suburb? That's a very bottoms up approach. And that's where we started. But then actually, when you look at it from the top, everything is driven by the supply of liquidity into the system. That's actually where it all comes from. And that's actually why house prices have still gone up in Australia over the last few years, because of the liquidity increase as well. Now, just to play on that a little bit further, as we think about that, if we go back to, if we just use the Australian real estate market as an idea, money doesn't flow equally into all suburbs.
Yeah.
The Australian property market doesn't go up in aggregate. You pump a bunch of liquidity into Australia, what happens? Does every suburb go up? I mean, during the COVID stimulus period, pretty much 94% of suburbs went up.
Yeah.
So that's the
average, yeah.
Yeah, but no, specifically 94% of suburbs went up.
Yeah.
So pretty much everywhere went up.
Yeah.
Then what happened? The liquidity tide started to drain back, and some suburbs kept growing or held value, and other suburbs contracted because they didn't have any kind of fundamental drivers. They didn't have these kind of, what is the reason the money would stick and stay?
Yeah.
And that's how you see the fluctuations. Now in Australia, that's driven by these things. Access to jobs, lifestyle, and affordability, right? They're the three things that are actually going to dictate whether a location is and a relative local affordability. That's the things that are going to dictate whether or not a location is going to be disproportionately benefiting or disproportionately disadvantaged by the expansion or contraction of liquidity.
Yeah, I think that's interesting. I was just remembering someone last week in the chat was asking about if liquidity is such a big driver for prices, then why do some areas go down? And surely it should all just continuously go up. But I think that makes a lot of sense. It's like the overall kind of middle line. If you imagine liquidity is what's setting the baseline across everything, and then the different factors of different locations are pulling that up or down on a local level, right?
Yeah. So it's the same. It's the same as saying, why do some companies go up in value faster than others? Right, so it's because there's a disproportionate amount of value creation happening in that specific pocket.
Yeah.
Right, so yeah, it does, and the things that drive value or the things that attract capital or create that disproportionate benefit from liquidity in the Australian market is jobs, lifestyle, and affordability. Right, and that's the reasons for it. So that's why not all markets go up equally, and that's also why you can have a market which doesn't perform, but as things change over time, the location may not change very much, but the dynamics around it may change, right? So, for example, Byron Bay is a really good example of this, where it goes in these cycles where it's cheap as chips, and then everyone goes, oh my God, Byron Bay is cheap as chips, and it's got a great beach. We'll all move there and we'll drive up the prices, and house prices in Byron Bay get to about the same level as Sydney house prices. And then everyone goes, Byron Bay, that's crazy expensive. We're not going to go there anymore. And then they stop. And this cycle's happened like a bunch of times, by the way, right? And then, so then everyone goes, bugger that. We're gonna think about other places. Capital moves to other places. Now, prices may go down, prices may stay the same or whatever, but the rest of the market moves, and then all of a sudden someone turns around and goes, Byron Bay looks cheap again. It's the same beach, it's the same town, it's the same everything. They haven't suddenly built a new magnesium smelter or something like that. It's the same thing. It's the same thing. But
I wouldn't put it past Byron Bay though.
Yeah, but the relative local affordability is the thing that's changed, right? The lifestyle is the same, right? And probably the amount of jobs are the same, but it's the relative local affordability that has changed, right? And obviously Byron Bay is a case where people move there. Yeah. So the relative local affordability is a lot of people who live in, say, Sydney going, Byron Bay looks cheap compared to Sydney. I'm going to move there because it's got like nice beaches too. So this is why you get this movement of capital. This movement of capital, and the way to think about that is actually really important to understand how this works on a global scale as well, because exactly the same thing happens. Why would money flow into China? And why would money flow into the US? Why would money flow into the UK? There's got to be reasons for it. And there's got to be a good return on the cost of capital. There's got to be good stability. There's got to be something that's going to drive returns over time, right? And so this is so it doesn't. It's not just this thing that kind of it just lifts all boats.
It's interesting. Time. It's interesting when you think about the countries as players in this global game, right? Because part of the job of the government, I suppose, in driving their economy is making the economy attractive to international markets, right?
Yep.
Part of Australia, the country's unique selling proposition, I guess, to other international markets is the real estate market.
Yep.
It's interesting when you think about politics, because then it's like, okay, there is to some degree an incentive to make sure that house prices don't crash to whatever degree that they can control.
Of course,
because they want to be an attractive option for the dollars that exist on this board game of the global economy.
Yeah.
They want to attract that into the country so that we have more liquidity to be able to spend on more things, right?
Yeah.
Yeah.
Yeah, that's exactly right. Yeah.
Cool.
And so different different assets are better at this than others. Right. And so, some of the best liquidity traps are real estate, Bitcoin. Bitcoin's got a huge correlation to liquidity.
Yeah.
Gold to some degree. Stocks are very US stocks particularly are very correlated with liquidity as well.
Yeah.
Yeah.
Yeah, I'd love to maybe dig into that a little more in terms of the concept of liquidity. I think people might hopefully be starting to understand. If you do have any more questions, chuck them in the chat. We've got the chat up on the screen as well. But thinking about how we can apply this in terms of picking what asset classes to invest in. Because as we've touched on in this episode and then in the previous one, talking about how pretty much in the state of the current economy, investing is mandatory if you want to maintain your purchasing power and not have it go backwards. And so the next step from that is applying liquidity and that understanding to pick which asset classes. Because we talked a lot about real estate. How do you know if real estate is the right thing to invest in based on the liquidity situation or other assets? So
here's the thing: is like I broadly think there's kind of three baskets to invest in, right? And that's it. So let me start again. So if you have a fundamental understanding that liquidity is likely to increase over time, then the question would be, where is that money going to flow to and why? And we've already kind of touched on it. So there's really three places liquidity is going to flow to, because everything else is starting to get demonetized versus these three very specific assets. So there's Australian real estate, Canadian real estate potentially as well. It sort of similarly has had similar dynamics to Australia, to be fair. But Australian real estate, US growth stocks. So now the reason I say that specifically is because small caps, Russell 2000, like all that kind of stuff, they're disproportionately, or they're much more sensitive to interest rate and liquidity changes. But if you look at the growth stocks, if you look at the companies that got network effects, that are deflationary, that are massively disruptive, they're the ones that are attracting capital in any environment, right? So that would mean that when liquidity is going up, they get more capital. When liquidity is going down, they get more capital, because people are going, okay, my money is going to be safer there than it is going to be somewhere else, right? So growth stocks in the US, Australian real estate and Bitcoin. Because at the end of the day, they're the ones that when liquidity goes up, people go, yes, there's more liquidity. I'm going to throw my money into these things because that's good. And then when liquidity goes back and people start shitting themselves, they're like, this doesn't feel good. Right, where can I put my money that's safest? Where am I most likely to get the best outcome? Australian real estate, Bitcoin, and US growth stocks. So that's sort of how to think about it. And if you just kind of take that in a kind of like a base level assessment, and then say, okay, well, if that is true, so when liquidity goes up, I should be investing in that kind of stuff. When liquidity is going down, I should be investing in that kind of stuff. And if I don't invest when liquidity is going up, I'm going to get further behind. And if I don't invest when liquidity is contracting, I'm going to be at deeper risk as well. Then you're sort of there's only one really direction that can point. Now, but it is very important to understand where we're at in liquidity cycles so that you can think about how to allocate capital effectively. So at the moment, we're sort of if you think about global liquidity being in a 5-year cycle, roughly, we're in the 5th year of a global liquidity upswing. So it's likely, not guaranteed, but likely that global liquidity is going to peak sometime in late 2025, potentially early 2026 at the moment. The reason I say potentially early 2026 is because the increase in the US dollar value at the moment has kind of stunted some of the global liquidity cycle. But if we look at the central banks across the world, we're moving into a phase of easing. I'm not sure if you've got that chart, that kind of like the one that's got the red to green on it.
I do.
Okay, well, don't worry. We can share it some other time.
I'm struggling a little with the screen share.
That's fine. We can do it some other time. If we have a look at government policies around the world, you can, and there's a heat map. we've gone from quantitative tightening or tightening policies, right? Not necessarily quantitative tightening, but tighter monetary policies, and we're moving globally into a stage of easier monetary policies, right? But we're also looking like we're getting towards the end of a 5-year to 6-year global liquidity increase cycle. So the thing to think about there is you should be mindful to not be exposed to highly risky assets, because what tends to happen when liquidity increases, you can push further out on the risk curve. So you might be able to sort of invest in kind of more speculative things or more volatile things, or you can push further out on the risk curve. If you can be aware that as liquidity contracts, the things that are further out on the risk curve they're probably going to be the ones that suffer the most. You should think about pulling your capital back towards safety. Now that used to mean going back to bonds, right? So bonds were typically risk off and equities were risk on. And real estate, depending on where you were, could be either, depending on which country you're in, to be honest, could be either. Bitcoin is both risk off and risk on. It's a very interesting asset in and of itself. So, but the way to think about that is if you know that the liquidity expansion is likely to stop or ease or come down towards the end of 2025, then you should start thinking about redeploying your capital in a way that's going to allow you to benefit the most. So that would mean moving out of riskier assets into safer assets. Australian real estate, very, 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 very good asset to be in both environments. Being very selective about what equities you're invested in. Being selective about what crypto projects you might be invested in. You've got to think about that. You've got to think about that from a risk management perspective, because as we sort of said earlier, when global liquidity expands, everything goes up. But as it contracts, it pulls back, and some places the money stays or more money goes to, and other places it comes out of, right? And that's where you start to see things crack and break, right? So you've got to be really careful of that. And so understanding where we're at in that cycle is really, really important for investors to make intelligent decisions. Now, again, this is also why I think it's interesting that Australia is sort of shifting slightly off the global refinancing cycle. Like, we haven't changed interest rates, everybody else has. I actually think that that's going to be good, because I think that's going to smooth out the Australian debt refinancing cycle and create more underlying stability for the Australian real estate market, which is going to mean that that's actually going to be a viable solution for a longer period of time. You don't have to worry about it.
So let's fast forward to the end of 2025 or 2026. And the cycle has started to turn again and things are starting to tightening up. If you haven't invested in assets between now and then, what does that look like?
So if we fast forward to the end of that period and you haven't invested,
as things are starting to tighten.
Well, it's a good question. What you would likely see is so we had some tightening and reduction of global liquidity in 2022, and what we saw things like stock markets sort of trend down and stuff like that. So you can end up in a sort of more bearish market generally, depending on what assets you're in. The more liquid it is, the more volatile it is, basically, right? So one of the reasons cryptocurrencies are more volatile than stocks is because they trade 24/7, right? So you can the more liquidity equals more volatility. So there's kind of two dynamics. It's like, if you know now that liquidity is likely to peak in late 2025, early 2026, how should you think about investing now? Should you race into the market and try and deploy all of your capital and go as hard as you can? Probably not, actually. You probably should have been investing over the last few years. You don't know what's going to happen when liquidity contracts, because it does depend on other policies as well. And we are moving into a stage where liquidity appears to be contracting optically because the US dollar is strengthening. If the US dollar weakens, we'll increase liquidity. Depends on local policies as well. So my advice would be to keep progressing with a plan steadily and slowly, right? So if you have a real estate investment plan, then stick with the plan, stick with the program, right? Because there's enough markets in Australia that you can position yourself to be beneficially, to be a beneficial recipient of the liquidity that exists in the system at that point in time. So, and if you don't have a plan, by the way, can we put a link below so that people can get a portfolio growth plan somehow?
Sure, yeah.
Yeah, so we'll put a link below this so you can you reach out and get a portfolio growth plan. Because if you have a portfolio growth plan, stick to the plan, basically.
Yep.
if you're investing in equities, you actually might want to think about, and if you've gotten good returns over the last couple of years, you actually might want to think about taking some profits, start to move into cash so that you can benefit by investing in things that are a little bit, as they get a little bit cheaper over the next kind of couple of years. Yeah. So we're likely to move in these kind of like cyclical waves. So 2025, if you're in highly liquid assets, is a good year to take profits. If you're in illiquid stuff like real estate, just stick with the program is what I would say. Just stick with the program because we're going to continue to see, particularly in Australian real estate, we're going to continue to see a strong bid, or probably a perpetual bid for the next. I can't see any reason at all that Australian real estate is not going to continue on its upward trajectory at around about 10% a year for the next foreseeable, because there's nothing that's going to stop it. Other stuff, I can definitely see reasons why liquidity would affect those assets.
So it's stick with the program, but make sure you have a program to stick with as soon as possible, right?
Yeah.
I think this is actually really important because I think, let's take Bitcoin as an example, right? Huge growth upswing over the last year in particular, but the last few years.
Yep.
And I think a lot of people, as it's starting to be talked about a little more in the mainstream media, people get this FOMO. People go, I've heard how much it's going to grow over the next 6 months. It's going to like hyper growth. I'm going to put all of my money into it. And there is a level of understanding if you as an investor have done the research and you feel 100% confident in that decision and you're comfortable with the risk, you can do whatever you want, honestly. But if you have not put in the hours, if you have not done the research, don't panic and get caught in that FOMO. Don't just go, I'm all in, and you're hearing about how my cash is going to turn to nothing over the next 10 years, and I want to make sure that I'm, putting it on a lifeboat, a life raft, and preserving it. Start with a plan. Like, if you're listening to this, if you're watching this, it's an awesome start because you are building that financial confidence. Like the first stage of financial freedom is financial confidence. And building that education, building up your skill set, building your understanding and knowledge is going to help you to not panic when this stuff happens and getting yourself into a position where you just feel confident and you can make bets, you can make calculated risk, and you can get yourself in. But then if things go south, you don't panic and pull things out, because I think that's what a lot of people tend to do. And we're talking about the long term here, right? In terms of everything that we're talking about wealth preservation, I guess, over the long term. There is a question here that I just wanted to cover, Goose.
Yes.
Which is, are you talking about using leverage or deploying saved capital into these assets for growth or wealth preservation?
So I'm going to come back to that question because I'm going to come back to that. No, I'm going to come back to that question because so Bitcoin is a really interesting one because Bitcoin is a great. It's got a very high correlation with liquidity. Okay, and so it's kind of breaking the correlation is breaking down at the moment, but that's a whole nother story. It's breaking to the upside. Yep. If you wanted to, like a lot of people right now, are like Bitcoin, let's get into Bitcoin, let's invest in Bitcoin. Yeah. The time for this cycle, the time to invest in Bitcoin was in December or November 2022. That was when you should have been investing. We're now in the last stage of that cycle. So if we also look at the kind of global liquidity cycle trends, it bottomed in late 2022, and it's likely to peak in late 2025, early 2026. Mm-hmm. Then it's going to trend down again. Okay, so you've got these kind of liquidity trends. Mm-hmm. And so what you don't want to do is you don't want to FOMO in with all of your money right now, because what may happen if you're in a highly liquid asset is those assets may come down in value over the next couple of years, which could represent a good buying opportunity, but also you don't want to be out of the market because you don't know how low those are going to go. You can't time the market. Yeah. So for highly liquid assets, the best thing you can do is to have a plan and stick with it and dollar cost average into assets over time, particularly now. So I know it'd be very tempting right now to be like, oh my God, I'm just going to YOLO into Bitcoin, but you don't know what's going to happen, right? Yeah, maybe it's going to go from $100,000 US to $500,000 US. Maybe that's what some people are saying. I don't think it's going to. Maybe it's going to do that, but maybe it's not. Maybe it's going to go from 100 to 120 or 150. And then maybe it's going to go back down to 70, and then it's going to go. So yeah, the way to think about that though is to think about it on the right time horizon. So when I think about Bitcoin, you shouldn't be thinking about how much money can I make this year. You should be thinking about what is this? What is this asset? What is this asset class? Now, the way that I think about Bitcoin is it's going to be worth $1 million in 2030. That's my point of view. My opinion only, right? So it's not a prediction. It's not a fact.
Yeah.
My opinion, based on my
having done the research,
1,000 hours of research, is it's going to be worth $1 million in 2030. And so if it's $100,000 now, then that's a discount to $1 million in 2030, right? So I think, okay, that's good. But my timeline or my time horizon is 2030. Now, then I put a discount on that and I say, well, what if I'm wrong by 50%? And what if it goes from 100,000 to 500,000 by 2030? Is that still good? Am I still happy with that? Yes. And if I believe that that is true, do I care if I invest today at $100,000 and then it goes down to $50,000? Do I care? The answer is no, because my time horizon is long enough.
Yeah.
So really, your time horizon really, really matters. Now, to answer the question, and the same thing goes with equities as well. And I'll emphasize that for liquid stuff, you want to keep a bit of cash on the sidelines.
It's interesting to think about I keep saying the word interesting. It's interesting, Chris. I think where something like Bitcoin or even shares differ to, say, real estate is because with real estate you can get leverage.
Yes.
And so with something like Bitcoin, the main points in terms of timeline are the time that you enter and what you pay.
Yeah.
And then if you ever exit.
Yeah.
If you care about fiat currency, what that would turn into, like those 2 points, entry and exit point.
Yep.
Same with shares. But with real estate, you have equity growth that you can then re-leverage to buy another property, or you can take out and buy another asset class. Or
So understanding the investment and understanding the asset class is really, really critical. So this will go to Braden's question here. Are we talking about using leverage or deploying saved capital into these assets for growth or wealth preservation? So it depends on the asset. Now, in order to make any investment decision, you must have an underlying thesis. So we'll do a separate topic. We'll do a separate episode just on Bitcoin perhaps. But I have an underlying thesis for Bitcoin. And that underlying thesis means that I actually don't care what the price is today. I don't care. I don't care.
Yeah.
Like, I literally don't care. I'm not going to sell it. So it doesn't matter. It doesn't really matter what the price is today.
It's only from the perspective of
how much can you buy with
should
fiat
I
dollars?
buy more? Yeah.
Yeah. How much can I buy with fiat dollars, right? But there's absolutely no chance that I would deploy leverage into Bitcoin. I would never do it. Not even like 2x leverage or nothing. I just wouldn't do it, right? So there's no chance. Now, that is a capital preservation play, and that is taking surplus fiat and putting it into an asset, which I believe is going to be a superior store of value over a longer time horizon. So that kind of answers part of that. So then if you think about equities, then the question would be, if you have to really understand what is the underlying driver and how related is the asset to cyclicality and all of that kind of stuff. So if I look at MicroStrategy, for example, which again is something that we're invested in, that is interesting to me because it's a Bitcoin proxy and it trades at a high beta to Bitcoin, which means it's more volatile than Bitcoin, which means it can have more upside than Bitcoin. But if I believe that Bitcoin prices may go down, which, to be clear, I do not care if the Bitcoin price goes down on the Bitcoin, but I do care about it with MicroStrategy. Why? Because I plan on selling MicroStrategy. That's a liquid. That's not a hold forever thing. So and again, I would not deploy leverage in that. Real estate, however. So let's look at Australian real estate. Okay, is it likely that it is going to be adversely affected by global liquidity? Probably not. I don't think Australian real estate prices are going to go down. Why? Because we've got stupidly high immigration. We've got a stupidly massive undersupply of properties available. We have a rental crisis, a housing shortage crisis. We have a government which is moving into an easing cycle. That's not just interest rates, by the way. It's moving into a liquidity increasing cycle. So some of the ways that the governments and central banks increase liquidity as well is they drain things like the Treasury General account, they drain the balance sheet, and they pump money into the economy. So there's tons of ways to increase liquidity outside of just interest rates, but it's likely that interest rates will go down over the next year or 2 years. That will increase liquidity, access to credit, access to capital. Monetary policy is becoming looser. Where in Australia we have a per capita recession, which is problematic, and the government knows that. And the only way it's being propped up is by increased immigration. So we have a kind of like a recessionary economy, right? And so the government's going to want to stimulate that economy at some point soon. So that's likely to increase liquidity. Okay, fine. So I don't think that there's a systemic downside risk to Australian real estate. So would I be comfortable deploying leverage in Australian real estate? Yes. In fact, I would go as far as to say not deploying leverage in Australian real estate would be stupid, right? There is no reason to invest in real estate without leverage. You can get better returns elsewhere. So from that perspective, I would be taking a certain amount of capital and I would be accelerating that capital with leverage in Australian real estate, but I would not be doing that in assets that I thought could be cyclically more volatile due to global liquidity, if that makes sense.
Yeah. This is a whole separate podcast, I think, because I think a lot of people, again, if we focus on Australian real estate, a lot of people come to Dashdot or they think about investing in property, or they think about just their wealth position and they might own their home, or we're all kind of raised with this understanding that we should pay down our debts.
Yeah.
And which in essence, if you pay down your debts, you are not leveraged, so you do not have
makes
leverage.
no sense.
And so this should be a whole nother topic, I think, because from an investment perspective, if this is the asset class you choose, it probably makes more sense to be leveraged.
Yeah. Taking out debt is effectively shorting the currency, right? You're effectively saying, I believe that the money is going to be worth less in the future than it is today. So I'm going to pay for things in tomorrow's money because tomorrow's money is worth less than today's money, right? And so I think that if you understand and believe, if you believe and understand that as a fact that the money is being debased, right? So the currency is being debased in Australia. Then why wouldn't you want to take? I'd take as much money from the future as possible because it's going to be worth less. So you're effectively shorting the currency by borrowing in that currency. And I think that's the best thing you can do. Because Australian real estate grows by, 8.25% a year since 1950 or whatever it is, 1960, 1970. So great, but you can do way better than that. And if you're only getting 8.25% a year, you're only treading water. You're not actually getting ahead. And after you pay taxes and stuff, you're actually getting behind. So it doesn't make any sense. But leverage is their great accelerator, and the Australian real estate is really good for that. So the way that liquidity relates, I think that liquidity is going to increase in Australia. I think that liquidity is going to increase globally this year. I think that'll flow into Australia. I think that Australian monetary policy is going to ease, and that's going to increase liquidity. That is going to pump property prices as well. And so you can either be a part of that or you can not be a part of that. I don't think it's going to go down though. So as you see liquidity contract, I don't think prices are going to go down, right? I think that what they'll do is stabilize, maybe go down, in some areas slightly depending on where you've bought, but in aggregate, you'll be fine. So the application of leverage needs to be done in assets that are going to be less volatile in nature so you don't put yourself at adverse risk. And all investing should be a desire to either preserve capital or increase capital. But capital preservation is as important as capital appreciation.
Yeah, something obviously to think about with that is, again, probably a whole separate conversation, but the idea of property being real estate, being an investment vehicle at all.
Yeah.
And again, coming back to the kind of the fundamentals of like a perfect economy. If it was all functioning perfectly and we didn't have monetary debasement, then maybe we wouldn't need to invest in things like real estate.
Yeah, and houses would get cheaper.
Yeah, they would get cheaper.
Yeah, so that's why liquidity is going to continue to increase, because governments need inflation. If governments stopped printing money and stopped creating liquidity, what would happen is we would have deflation, and deflation would cause house prices to go down, which means the collateral base of the country would go down, which means that everyone's retirement, everyone's hopes and dreams and future and everything, and all the money, all the wealth, 76% of Australian wealth is tied up in Australian real estate, that would all go down, and that would be very bad. And debt would cost more, the future money would cost more than today's money, and it would be bad, and that would mean the government couldn't pay it down. So if you can understand that cycle exists, then you can understand that liquidity is going to continue to increase, right? Even as AI and stuff comes into the world and we start to see deflation through technology, the degree to which we experience deflation through technology is the degree to which we're going to see increase in monetary inflation, because it has to offset it, because governments can't afford deflation. And so if you understand that the governments can't afford to have deflation because it would bankrupt their entire country, then you can understand that, and if you understand that that money is going to flow into real estate, then you have no reason to not buy real estate, because you know that it is going to go up perpetually to the degree that the government continues to increase the money supply.
Yeah. It's, I'm not going to say interesting. It is something for people to consider in terms of if they are waiting for a housing crash.
Oh, yeah.
And I think...
I don't know what you're waiting for. People have been saying that shit for years.
No, I know, but I think a lot of people, like, the affordability crisis is very strong at the moment. And so I think a lot of people are holding out hope that there has to be some kind of massive correction happening so that they can get in.
Yeah.
And I want
It's not going to happen.
Because a large part of why we're doing this podcast at all is we just want to help people get in and get their money out of cash and into something.
Yeah.
And a lot of people, real estate is going to make sense, but then also it's not as affordable for a lot of people right now. And so I think those people are holding out hope that it will come down so that they can invest in real estate.
It's only going to get worse.
I think we need to come up with some strategies for people to kind of leapfrog into home affordability rather than waiting.
So that's why you need to have a strategy that's not just real estate, right? Because if real estate prices increase faster than wages increase, so it's only getting harder. In fact, I did a episode a little while ago, and we calculated that it was about, if I remember correctly, 12 or 14. It's getting 12 to 14% harder a year, right, to buy real estate. Yeah. So it's not going to get any easier, and there's not going to be a big crash. It's just not going to happen. I actually don't think that we're going to have recessions again globally. I don't think it's going to exist. Or if they happen, they'll be very, very, very short term. Yeah. Right? Because governments now know they can hit the money printer, and that increases liquidity, and that solves the problems. That started in the year 2000 with the dot-com crash, then 2008, then COVID. The money printer go burr, solves all the problems. We've got a comment here. So your property portfolio can grow itself through growth and leverage, inflation. Yeah. So your property portfolio will grow itself through inflation and leverage. And spare savings in between properties can be directed into shares and crypto as a long-term hedge on inflation. That's exactly right. So the way that I would think about this, the other layer to that too, is that you can create an infinite money glitch through real estate. So let's say, just for simplicity's sake, let's say it takes $100,000 to get into a property and buy a property, right? So you take $100,000 of your capital, you go buy a property, right? Then it goes up by $100,000, great. You take, and then you refinance and you take $100,000 out. You've taken all of your capital back out. Now, all the money in your property portfolio is an infinite return. And you can take that initial capital and you can go deploy that into other things that you may desire, such as equities or crypto or whatever. So that's one way you can do it. So then everything that happens in your portfolio, it's an infinite return. It's an infinite return. Now, you don't have to do that. But that's one way of doing it. Now, the other thing you can do is that you can use, if you understand liquidity cycles, you can use crypto and stocks or equities as a way to accelerate your capital. This is why you need to understand liquidity, though. So if in 2022 you were like, I want to save for a house, but saving's hard, how am I ever going to get ahead? If you saved all of your spare money in Bitcoin over that period of time, you would be able to afford to buy a house now way easier than if you just saved in cash. However, if a liquidity cycle is coming to an end, that strategy might not be as good of a strategy, because if liquidity is going to cause a contraction in those assets that's going to be greater than the debasement of the currency, then you're going to be going backwards, not forwards. And so you've got to be really mindful of these highly liquid assets and how you deploy capital into them. So in principle, yes, you should be investing your surplus capital into other appreciating assets so that you can increase your capital to a point that you can then deploy it into real estate and get leverage and create that kind of infinite money glitch and keep that going. But you do have to be very mindful of liquidity cycles, because if you do that at the wrong time, you can find your savings going backwards, not forwards.
Yeah, and what comes to mind is obviously our property portfolio. When we started, it started with a deposit. Yeah. Different environment now. Affordability was better back then, but one deposit, asset grew, refinance, another deposit, refinance. That one deposit, I'm pretty sure, I think we had to put in like $1,600.
We basically 15x'd our capital in 5 years.
Wild. Yeah. But it's a similar, in that situation, that was a certain liquidity environment and that was a certain asset class, and it was like the combination of the two at that timing. Yeah. Meant that we could have that result. And I think not taking cookie cutter approaches to things and applying them at different timings because you're in different points of the cycle.
Totally, and this is why it's important to understand liquidity. Because if you're in a liquidity expansion period, then like push your money out as far as you can, get it to hoon, right? But if you're in a contractionary period, then you need to be very careful about where you're putting the capital. Yeah.
Cool.
Sweet. Useful?
I think so.
Great. Let us know in the chat if you guys found this interesting. I think this is a great topic. Yeah. And there's a lot more to come off this. If you guys have any questions, drop them in the comments section. We will get back to every single person as well.
Yeah,
let us know if there's any specific topics that you guys want to hear and you guys want to see. We will make sure that we cover them. Yep. If you want to get specific, we can get specific. We're here for you. We're here to grow this. And if you found this useful or interesting, make sure you share this with somebody else who might find it useful and interesting. Because that's going to help us to help more people, and that's why we're doing this.
Yep. Do you have any good resources to learn about liquidity? Good question.
So there is there's a paid newsletter that one source is there's a guy called Michael Howell from Cross Border Capital, and I subscribe to his newsletter, and it is the only paid newsletter that I subscribe to. I can't remember how much it costs. It is very nerdy, academic. It's not an easy read, but he's a great source. He's a great source on that. I also put together a cheat sheet or a quick reference guide to global liquidity, cross-border capital flows, etc. And we can put that in the show notes as well. Last time we tried to share it in the chat, but it didn't work. So what we can do is we can put that into the show notes, and that'll just give you a quick reference guide to like how is things like what is global liquidity, how does global liquidity get created and reduced, how does global liquidity affect asset prices, what's the role of interest rates in cross-border capital flows, what assets benefit from increased liquidity, where are we at in the current liquidity cycle. It's just a bit of a cheat sheet that I put together. I tried to keep it really simple, bullet point type stuff, just to kind of give you some cheat sheet stuff on that. So we'll put that in the show notes so that you can get access to that, and that way you can kind of get your head around it a little bit more.
Awesome, yeah. And on Sundays at the moment, we're also doing a written summary in the lab report via email. So if you want a summary of everything that we've kind of talked about today in a written format that you'll read in like 2 to 3 minutes, and any of the links that we share as well, or if we mention any books, if we mention any other resources to look up, or if Goose puts together any impromptu reports and Google Docs that we can't quite share in the chat, that'll be in the lab report on Sundays as well. So if you are not on our email list, I do not have a link to share right now, but I might hopefully get one in the chat in the show notes in the YouTube description for you to sign up. Otherwise, if you have any questions, do leave them as a comment on YouTube. If there's anything that came up that we didn't quite cover today and you want to know more of, chuck a question in the comments on YouTube, and we'll come back to you throughout the week. As well, like Goose said, share this with people. We are doing this because we want to broaden everyone's financial education and understanding of the economy so that you can actually take action and move ahead. Because knowledge is one thing, but you actually do need to do something with it. And I think this is a big challenge with the kind of financial space and thinking about investing is there's so much information, there's so much confusion that people just don't do anything. And we're really trying to be here to help you to push through that and just get yourself onto a life raft of some sort, because your money, I don't want to see your money and your savings and everything that you've worked hard for just kind of corrode.
Yeah.
We want to help you to take action. So if this is not actionable enough, I want to hear that feedback as well.
Yep.
If you don't want to leave it in the chat or in a comment, you can email us at podcast.
Put it in the comments, just because freaking hate going on in the comments. Tell us what. No, I'm joking. Sorry.
Thank you. You can do whatever. Do whatever. You're a free human. Do whatever you want. Otherwise, if you don't want to do that, you can email podcast@dashdot.com.au. We'll pick up that feedback as well. I really thrive on feedback. So even if the audio sounded shitty, let me know. If something is weird about the visual, let me know. If the topic was too deep or not deep enough, or you feel like we could go another way with the content, let us know as well. Any feedback, anything good, anything bad, any other ideas, shoot that through and share this with people that you want to help invest as well. So
yeah, just
awesome.
a footnote to that as well is I think the world is changing faster than people realize. And you really have the next few years to make some really powerful financial decisions. And if you miss that boat, you're going to be really left behind. And that's why we're doing this now, because we actually recognize that between now and 2030, the world is going to change in ways that most people can't even comprehend. And unless you get on that life raft, you are going to be left behind. And that's probably going to work out pretty poorly for you. So the reason we're doing this and the reason we decided to start doing this live, the reason we decided to start getting back into it is because we can see what's going to happen over the next few years and we want to help as many people as possible get ahead. So give us the feedback. Let us know how we can keep helping you, what topics are going to be useful for you guys, because we really just want to help you guys get ahead. So cool.
Awesome. Thanks guys.
See you in the next one.
Have a good week.
Bye.